Hello everyone. I am more than delighted to be able to present today the book which is called Compounding Secrets, and it is a subset of all my learnings through various sources, through mentors, through the Technofunda community, whatever I learned through a lot of influencers I've been following since I've developed this interest in investing assets, and also through a lot of mistakes and lot of emotions that I have faced while going on this journey. A lot of doubts that I have had, a lot of experiences that I have had, and whenever there was a bottleneck, I just kept on thinking about things that okay, what could be a solution to it? Sometimes I referred to the community member, sometimes I pondered upon it, sometimes I googled upon things, sometimes I read books. So this book is actually a culmination of all those learnings, which is not just related directly to investing. It is majorly an investment related book. It is majorly for equity investing, but it also has an essence of what compounding is and why it is very powerful. And eventually, it leads down to how we can implement the same concepts in life as well. Yeah. So, on that note, let us begin. So, I like to go chapter by chapter so that we can cover most of the part. It might happen that we might not be able to complete the entire book today itself because there are a lot of things that have been discussed as such. So we'll try to make the maximum of this session, and once uh, we are done with say half of the book, then maybe we can take it forward in the next session, and we'll go chapter by chapter. And if there is any question that somebody has, or if there is any doubt or any deeper insights, if somebody else wants to share, or maybe a counter argument, so please feel free to interrupt me. It will be more like a discussion that we'll be having today. And the goal is to understand compounding at a very fundamental level, because once we understand the fundamentals, and everything else is just a byproduct of it. So the goal is to understand compounding from the very basics, and this book will build. It will it's like the compounding chart. It will build like the compounding chart. That the initial part might be simple and slow, and gradually it keeps on building. All the concepts keep on building on each other, and the book starts becoming more powerful towards the end. So that is how the flow will be. And what we will leave with today is a simple compounding mental model that you can apply not just in stocks, but in all spheres of your life as such. And we'll essentially be discussing the Technofunda decision framework because this is not just the reason that I'm part of this investing community, but I have tried to have a lot of counter arguments in my head why not Technofunda and why some other way of investing. And I always found this to be one of the most powerful approach as such. So that is why we will be discussing that. And we'll be also discussing practical rules for entries, how to allocate, how to take exit calls, and all the behavioral biases. All those things we'll discuss in the session. So I've divided the book into four parts with, of course, a preface and bonus at the end. Preface at the beginning and bonus at the end. But the major four parts are part one, which covers the foundations of compounding. Part two is why equity, understanding, the basics. And the part three starts with 36 secrets, which have been clubbed into individual chapters so that, for better clarity and better flow as such. So part three will cover all the 36 secrets that I've tried to share. Part four will be life and how to think about compounding beyond money, and what kind of infinite game this could be. And eventually, a daily checklist that could help us stay the course, because compounding becomes really powerful as we stay consistent and we spend more time. So, consistency and discipline is the key. So, for doing that, we'll be sharing or discussing a daily checklist that one can follow so that we stay on the course as such. So the first question is why I wrote this. I'm not a finance person. I am an IIT graduate. I did my civil engineering from IIT Bhubaneswar. And as a child, I wanted to become a singer, and my path was music and civil engineering. That is what I thought as a kid. And I also recorded my first music album in the year 2010 when I was still in college. I passed out in 2012. Uh, and somehow that time I came across a movie director, Bollywood movie director, Kawal Sharma. So he was shooting in my city, Bhopal. My parents went and they had an interaction with him, and he was looking for a lead actor in that film, and he was also, and there were also three songs in the film. So my parents, came in touch with him, and they wanted, they pitched me to be a singer in the film, and they gave me gave him my album, and that is how we came across that Bollywood director, and he agreed to give me the songs of the film. And later, when all the auditions were done, he was not able to find his character, but he thought of I did not I had no acting plans as such, but still life has its own ways, and he took an online audition. I was still in college, and we had an online audition, and then he chose me for that role. And the film is called Lucche Lafange. It was initially titled Delhi Eye, and if somebody is curious, you can go to my YouTube channel, or it was later released under the banner of Venus. The film was not a mega hit as such, and in fact it was released low key as per my expectations. So that is why I did not continue that field, but that is an adventure worth mentioning. So I gave some good 3 4 years of my life on that project. The film is called Lucche Lafenge, and this screenshot you see here is from the song Zyada Se Zyada, which is also one of my favorite. So I started from music, then I went into films, and just after completing this project and post release, I also parallelly started, since I was also had a nudge for entrepreneurship. So I parallelly started with a very small design agency with my now wife Anubha Saxena, and we started very small with a design agency, and eventually that agency built into better design skills, and those design skills we thought what could we do next, and eventually we formed the brand called the Banyan tea, which is one of my key venture. And so that is my journey, starting from music and then IIT, movie, and then eventually entrepreneurship. And somehow till now there is nothing hints of finance, and that is the truth. I am not a finance background person, but when after COVID, I came across a session by Vivek sir, and I attended the webinar. He explained all the concepts of what investing can do. So that time I quite resonated with it as such. And one thing I understood at that particular point of time is that I've been working so hard since almost decades after my graduation, and what we tend to do is that we our focus is always on earning, and we keep on earning, and we keep on either reinvesting that earning, or we keep on spending that earning, and we are just always running behind something. But what I understood post attending that webinar was that investing is something that can give you time freedom. It is something where your money can start working for you. So it is not just a pastime or a part-time passive stream of income, but it could actually become a very legit passive stream of income that can make you not just financial free, but also give you a lot of time freedom as such. Another thing that I resonated was with that it is not gambling. Stock market investing or investing as such is not gambling. It is systematic, and wealth, whenever is created, it is created by building assets. Assets could be anything, and there could be multiple ways of investing in assets. But ultimately, wealth is built by creating assets. One can become rich by doing whatever he is doing, maybe by doing a fancy job or doing a business and saving a lot of money. But if but the difference between rich and wealthy is that the wealthy people build assets, and wealth creation is not a magic. It is not a matter of luck. It is ultimately frameworks, which is a learnable skill. So all those things were there, and I had a very brief investing background, which was also quite funny. So what happened was that my wife's cousin came to our office, and we were just sitting down, and he used to invest in stock market, and he forced me to open up a demat account, and he asked me to do some small adventures and gave some shares, some stocks, some script names. So we blindly put some very basic amount there and invested in those stocks. And I thought that this is going to be life changing, because this is how the wealth is created. And what happened? Did I, double my net worth? No, I did not double my net worth. I lost a few in stocks. And he also introduced me to crypto. And in crypto, we actually doubled our money. And that time, Elon Musk was favoring Dogecoin, and he was tweeting, and we were very closely following him. and seeing that what kind of tweet he is putting, when is the next interview scheduled, all those things. And we just made that, track that window, and we could double our money in crypto. But did it double my net worth? No, it did not. Why? Because we invested only a few thousand. There was no good allocation as such. So we invested a few thousands, we earned few thousands in crypto, and we lost a few thousands in stock, and we were just there. But when I came across the community and Vivek sir as such, and when I started to go deeper into it, then I understood that it is a system, it is a framework, and that is the preface, and that is how everything started. And then eventually compounding, like it does, that everything compounds on itself, layer by layer. We keep on learning, we keep on learning, we keep on brainstorming, and then things start to materialize even in our heads and in our life. So the next natural question is who this book is for. So this is the book Compounding Secrets, and like we've discussed, it is in four parts. Covers compounding secrets, 36 compounding secrets, talks about compounding beyond money and all those things. But who is this for? So it is not a beginner's manual. It is for investors who want a repeatable process that can survive uncertainty and volatility. It is for those who believe in long term and are here for wealth creation and not making some quick bucks. This book will help you make better decisions, use frameworks whenever there is an uncertainty, and it will also emphasize and encourage you to be disciplined in the process. And once a process is set, then to follow it through volatility so that compounding can do its magic. And it is for your everyone who is listening here and everyone who is reading, I'm addressing to them, that this is for your younger self who chased big leaps. We always thought as kids and young adults that it is about that one big moment. It is that about that one big shift. It is about that one big investment idea that will help us take leaps and bounds in our life. So this book is for that younger self. It is for the current self who are seeking real investing principles, because now we understand that um, there are frameworks and there are systems. So what are those frameworks and systems? And it is for the future self, which is hoping that whatever frameworks we follow will not ultimately collapse. They will compound, because when we give time, we want things to compound in a positive manner. And we do not want to end up with a framework and do not want to end up with an approach which is not able to compound. We are going forward and coming back. We do not want that. So a non-collapsible system. So this is basically for your younger self, for you, and for your future self. So now let us begin with the part one, which is the foundations of compounding. I'll try to quickly brush through this part because most of us understand what compounding is, but still, it would be a good to touch upon topic. And started with a quote saying that doing nothing is also strategy. It just compounds to nothing. So we can just keep on doing whatever we are doing in our lives and take no action as such. So this quote encourages action taking. We can celebrate our weekend, or we can just do whatever we are doing in our lives and do nothing about it. So that is also strategy. That is also a way to live through life. But if we want to grow through life, and if we not just want to go through life, so for that we have to compound. And if we do not take actions which compound, then it will not lead to any great outcomes. So doing nothing is also strategy. The only issue is that it just compounds to nothing. So on that note, let us begin. So the first natural question is that why isn't compounding popular? We understand that compounding is a very powerful concept, at least in the community, all of us do. But still, it is not very popular. Even we are not taught these concepts in our schools. We are not taught in our colleges. Even if we look around our families, even after knowing the concept of compounding, if I try to talk to anybody, any of my friend or my family member or anybody one around, people are not that much interested. And so one issue is that people are not aware. That is first thing. And even if people are aware, even if they have certain sort of information, they are unable to digest that information actually. The primary reason for that is our brain is very linear. However, the reality is exponential. So what we think is that we did X, we got X result. We did Y, we got Y result. And if we do not do X, we do not get X result. And if we do not do Y, we do not get Y result. So that is our linear thinking. But what is reality? Reality is that everything compounds, everything gets stacked layer by layer. Things don't just add up, they even start multiplying. And the reality is that all our past efforts and whatever we do today, they echo forward. And one thing relates to another, another things relate to yet another. And whatever we see, the relationships we have, whatever we do in our life, whatever our bank balances are, it is actually, everything is connected. All the dots are there. We just need to connect those dots to understand. So that is the reality, actually. That's second issue, that why isn't so popular is the myth of overnight success, because all of us believe, or at some point of time at least we did, that it is about an overnight success, and we that is the reason astrologers are so popular. That is the reasons we so much believe in numerology, astrology. I'm not denying those sciences; they are sciences in themselves. But the thing is, one should not be discouraged by doing anything which discourages action taking, because unless we take action, those actions cannot compound. So even if we want to increase our bets by following astrology and predictions and all those things, but even for getting some output, we have to put in the fuel. So nothing should discourage us from putting that fuel. So that is a myth of overnight success, because the actual success comes from compounding. What looks like an overnight success is actually years of consistent compounding that has been happening, and we are seeing the result today. For example, suppose if someone cracks a very difficult exam, so was it an overnight success? No, probably that kid have been a bright kid since childhood, and he has been studying really well. He has been taking the concept forward, or maybe at least during the course of exam or course of preparation, he has been spending tens of hours of each day for studying, and all that effort compounds into something which we see as an exam result. So it was not an oversight success, it was a result of a lot of compounding. Similarly, if we see a politician becoming very popular, so even if somebody gets fame overnight, but for getting there, just for being there in that position and in that setting where things can compound and that success can become visible, that person probably would have been, working hard, and even if not hard, working at least continuously, daily in that field, and then that politician becomes famous. Same logic goes with actors, businessmen, business empires, and celebrities, everybody. Wherever we see that there's an overnight success, actually there has been a lot of past compounding which we do not see. So that is the myth. Third thing is wrong mental conditioning, that we are conditioned for taking very safe bets. We are taught that risk is not a good thing, leverage is not a good thing. And again, we are taught, that linear things, that you have to do this to get this kind of things. And the fourth thing is that we want to believe in magic instead of logic. We want to believe in magic. That is how a monkey mind works. And I call this the Kaun Banega Crorepati illusion. So if you think about it, Kaun Banega Crorepati has aired almost 20-25 seasons till now, and millions of people have participated. In my family, there are few people who I know have been trying to get into KBC since the time it has incepted. Maybe till now, they still have not got chance, but they have not stopped trying. Why? Because they think that that is their way to become a crorepati. However, when it comes to stock market investing or building assets, not just few hundreds, because kaun banega crorepati, even if you are able to get into that hot seat after so many participants, only 20-25 people were able to achieve that crore mark, and they are again not able to sustain that because they do not know where to now, what now to do with this money. So that is again the issue. But still, our mind wants to go into that direction, the magic kind of direction, and it does not want to go the logic kind of direction. So if we see stock market investing has created not just hundreds, thousands, but lakh of crorepati, not just in India, but even worldwide, because that is the framework. But we do not want to learn it. We do not want to invest our time. Do not want to invest our money, and we do not want to invest our bandwidth. So that is another reason why it is not very popular. So I'll quickly just take two, three quick examples to further deepen this concept. Just a moment, please. Oops. I think my screen would not be visible right now. Yeah. Is it visible now?
Yes.
Okay, great. So let us just quickly go through this small story so to understand the power of compounding. So there was an ancient kingdom in which a sage came to visit that kingdom, and the sage introduced the king with the game of chess. The king saw it for the first time, was really excited, and he said that whatever you want, just ask, and I'll give it to you as a gift. He said that I just want some rice, and how I want it is on the first box I want one rice, on the second double of it two rice, on third four rice, like that. So the king thought that okay, this is a very small request, and even we would at first think that it would be what some kgs of rice and or maybe a few sacks of rice. So the king humbly agreed that okay, you can take it. But when the minister started calculating, on the 11th square there were 1024 grains. On the 21st square there were 1 million grains. On 31st square there were 1 billion, and on the 64th, if we combine all the 64 squares, so it was 18.4 quintillion grains. How much is that? The number is just below in the slide. That is the exact amount, number of grains which were required to cover the chessboard. And it comes approximately 18.4 quintillion. And if we, compute the weight of the rice and what kind of weight of that rice, so it is like thousands of years of rice that mankind has produced globally. So that is the thing, that just a simple chessboard example, we are doubling from one single rice, and just doubling it 64 times, that amount is so huge that we have not produced that kind of rice in thousands of years as a humankind, as a world, as like globally. So that is something to ponder upon, that this is the exponential reality, and we are our brain is linear, so that is why we do not understand the concept. Next quick thought experiment is the 30 steps example. So we have to take 30 steps, and if we are taking regular steps, we can just walk across a room, or maybe need say some 20-30 meters of distance to cover. But what if I tell you that if we have to double the step size, so what will happen in the 30th step? So first step will be 0.8 meters, then 1.6, 3.2. Step 30 would be 4,29,497 kilometers in length. And if we combine all the 30 steps together, they will form 8,59,000 kilometers, which is enough to circle the entire Earth nearly 21.4 times. So that is the power of compounding. That is the power of doubling things and then keep doing it again and again. Another example is even interesting, because now we are talking about a paper which is like very thin, zero point 0.1 mm maybe in thickness, and we are assuming that it is a mental experiment. We are just assuming that we are able to somehow have a big enough paper, and we are able to fold it again and again and again. Whenever we fold, the thickness becomes double. Then we fold, it again becomes double. Then we fold, it again becomes double. So the starting point was zero point 0.1 millimeter thickness. And when we could fold it for 40 times, hypothetically, the final thickness of the paper would be 110,000 kilometers, which is almost 9 times the diameter of Earth, or nearly 3 times Earth's circumference, or about one third of the distance to the moon. So just by folding a simple paper, if we are able to fold it 40 times, we can reach one third the distance of moon. So that is the power of compounding, actually. So that completes chapter one. Coming to the chapter two, we'll very simple concepts, and then it will build into deeper insights. So simple interest is like a vehicle moving at constant speed. Say if we are moving at 10 kilometers hour, it is going at 10 kilometers hour per hour. Compound interest is like an accelerating vehicle. So the speed keeps on increasing from 10, 11, 12, 13, 14. As we keep on moving forward, the speed is increasing, it is accelerating. So it becomes very evident that which vehicle will reach the destination first. Of course, it is the one with the acceleration, and it will not reach, it will reach very fast, very than the vehicle which is moving at constant speed. So that is a very simple example to illustrate the difference between simple interest and compound interest. Another important concept to understand is the momentum. So momentum, all of us understand, is once that momentum is built, it is like the hidden force, and initially it looks that things are moving very slowly. But once that speed is attained, that momentum is attained, then it is very difficult to stop something which is at a very great momentum. So that is another thing to understand. And just taking a small example of what could be a journey of 10,000 rupees over 30 years. So if somebody is investing 10,000 rupees per month for 30 years, so that saving alone would be 36 lakh rupees. How powerful is that? How is that? Just saving 10,000 rupees each month for 30 years, we are consistently doing it. That saving alone is 36 lakh rupees of corpus. And if we are investing it in something like Nifty 50, which has historically given 12% of return, that 10,000 rupees SIP will lead to 3.5 crore rupees of corpus in 30 years. How interesting is that? But the next lesson is that not all returns are equal. So this is not the end of the lesson. This is the starting of it. So here we have quickly compared three instruments: fixed deposit at 6%, uh, Nifty 50 investment at 12%, and direct equities at 12 at 25%. Same 10,000 rupees monthly investment for 30 years. Now see what how the outcome differs. The first instrument will give you 1 CR rupees after 30 years, second 3.5 CR, and direct equities, if you are able to do compounded 25% from 3.5 CR, it will go to 80 to 80.82 CR. So that is the power of what we are doing here. That is the power of 25% compounding, and see the staggering difference between uh, how just the doubling of rate of return can make on your portfolio. Okay. So in the next chapter, we are trying to break down the formula. We all of us know this, that amount is equal to principal into 1 plus r by n to the power nt. N is the frequency of compounding, t is the time, r is the rate of return, and p is the principal amount, right? So to understand that ultimately what we want from the compounding, we want that our amount should be, maximized. So a point to think about here is that what are our controllables? Actually, there are four controllables, and all those four controllables are control. They are controllables for a reason that we can control them. We can control what is our principal amount, and if we think that today our portfolio size, the starting amount is not big enough, so that gives us a reason to earn more, and that gives us a reason to upgrade our skills. It gives us a reason to save more, and it gives us a reason to have a tighter risk management so that we can protect the base capital and avoid big drawdowns early. So if we think about like that, so we would be more focused on a principal amount, and second is rate of return. Now rate of return is again controllable with the instruments, and with the scale process and the kind of discipline we follow, the rate of return can be controlled. And since n is how much time, how frequently are we rebalancing, how frequently are we reinvesting. So we are choosing between trading or investing or weekly time frames and monthly time frames, and that is another controllable n. And time is of course the greatest of all in this equation because it sits in the exponent. So the moral of this explanation of the formula is that ultimately, if we stay longer in the game, that is where the maximum leverage is. But starting amount and what kind of process are we follow are equally important. So when we start, we have to first fix what is our principal amount, what is the kind of framework we are using so that our rate of return is maximized to the extent possible. And then we have to develop a mindset of being in this game for a very long time, because time sits in the exponent, and that is where the magic happens. And we'll quickly do some case studies to understand this further. So case study one is the power of starting capital. Very simple example. Somebody has a portfolio of 10 lakh rupees and 20, 30, 40, and so on. Somebody has a portfolio of 1 crore rupees. We are just investing in Nifty 50 for 30 years at assuming 12% return. This 10 lakh will compound approximately 3 CR, 20 lakh to approximately 6 CR. And eventually the 1 CR portfolio will have 30 CR. So what we are seeing is that uh, our process is same instrument, same holding period, just the starting capital is changing and the final value is changing. So what we can see is that how each additional 10 lakh rupees is actually adding to the corpus. So that is very important to understand that what are we starting with, because most of the time we are focused on finding the next multi-bagger idea. But it is not just about that rate of return. It is also about what rate of return are we earning on the capital. If our portfolio size in itself is small, even if we get 22x, it is not going to make much difference. So that is a part of starting capital, and that is the point I want to emphasize here. Case study two is the role of rate of return. So for the what is the role of rate of return? So I have taken four different rates of returns for illustration. One is 6% fixed deposit. Second is 12% Nifty 50 index. 25th, 20, then is 25% the one that we follow in technical fund investing, the benchmark, which comes from a skilled equity investing. It is like index beating returns we get year on year. And then there is something which I have highlighted is 50% rate of return. So this might seem unbelievable for a 30 years of horizon, but I want what I want to highlight is that at least we should be knowing that what is the possibility, and accordingly we can, if we know the ceiling, accordingly we can choose our battles, and accordingly we should know what we are pursuing. So that is the reason I have highlighted this. And 50% is not unachievable in our community by riding winners and allocating well to it. People have attained this rate of return year on year. And then people like Mark Minervini have also done 100% return and triple digit returns. They have been doing it consistently. So assuming that rate of return is a learnable skill, that is what our assumption. But just see, at 6%, the corpus will grow to 57 lakh rupees if we are investing 10 lakh rupees for a 30 years horizon. I believe I'm audible. Can somebody quickly confirm?
Yeah, you're audible, sir.
Yeah, so even the flow speed, everything is going fine.
Yeah, it's clear in pitch also.
Okay, great. So for 6%, the corpus size will be 57 lakh rupees. At 12% return, it will be 3 CR rupees approximately, with a growth multiple of 30x. At 25%, this will amount to 80.7 CR rupees. And with 50%, which is like an active maybe trading or a high skill trading, or we are getting really good winners in a portfolio, we are allocating really well, riding them well, and have a very robust exit system. Assuming that this 80.7 CR can become 19,100 CR by doubling the rate of return. So treat this as a pursuit, not as a promise, but as a pursuit, that this book will not be able to give you 50% return for sure, but at least this kind could be a good starting point, and we can understand it why these things matter and what kind of impact it can have. 57 lakhs to 19,000 crore rupees. That is a very big alpha, very big delta, and at least it will inspire us to learn more, refine our processes more, and you know get to whatever highest rate of return we can in our investing journey and such. Now let us come to case study 3, where we have talked about time, how time can change things for us. So in case study, we have taken same starting capital 10 lakh rupees and a consistent rate of 25%, essentially creating index beating returns as such. Here are the growth multiples, and with on like 5 years after, this 10 lakh rupees will become 31 lakh rupees at 25% compounding. After 10 years, it will 93 lakh rupees, and so on. And usually all the lessons end at 30 years. Even we have discussed this again, like 80.7 CR will be the amount after 30 years. But what I've tried to highlight is that what will happen after 40 years, what will happen after 50 years, what will happen after 60 years. As we give more time to it, now see the magic actually starts at the end. After it already started at 15 years, when that crore amount has started to hit from a portfolio 10 lakh rupees itself. But now see how beautifully this magic is playing. At 30 years it is 80.7 CR. At 40 years it will be 752 CR. At 50 years it will be 7,006 CR. And similarly, at 60 years, it will be 6,000, 65,253 CR. That same 10 lakh rupees, we are not adding anything to it, just giving it more time. It can become 65,253 CR. So what I want to highlight here is not that we are going to live for 120 years, and if we are not going to live for 120 years or so, what is the point of even talking about this? So the point I want to derive here is that once we understand the importance of time, one, we can start early, we can stop delaying our actions, because the more time we get, the better it is. Second, we can we might not have as adults 60 years to enjoy, but we can pass on this knowledge to somebody who is younger in our family, maybe our younger brothers, maybe our younger sisters, who are at the age of 18 years, and they can get this leeway. And maybe we can build portfolios for our children, and maybe we can teach them early so that they are able to at least you know what I want to highlight is, more than skill, our focus should also be on to pass on the knowledge, to tell people about the importance of what compounding is and what it can do in the later years, and have happy families, healthy lives, so that just by staying there we are able to multifold our portfolio returns as such. This is a case study 3. Case study 4 is more of a practical approach. These were ultimately figures which we discussed, but I wanted you to raise the ceiling of your thoughts as such with these case studies. With case study 4, I've tried to quote a more practical example where we can blend active income with passive income. So another thing that I've observed is either people are investors or people are non-investors. there are only very few people who are, sorry, either people earn active income or they earn passive income. There are very few people who believe in combining these two. And when we combine these two, it becomes, more the merrier. So what I want to highlight with this quick example is, suppose whatever we have been doing, we are able to save 10 lakh rupees. We built a portfolio around it. And now, since we are following an approach which allows us time, so we are not quitting our job, or we are not quitting whatever we are doing, and we are able to save 10,000 rupees with our active income. And we are doing an SIP, and annually we are bumping it up with 10%. And our investment horizon is again of 30 years. And rate of returns are like 6, 12, 25%. So for the sake of brevity, let us just see 25% rate of return. So by blending both active and passive income, the lump sum contribution will give 80.7 CR, and the step up SIP contribution is giving 71.5 CR. In total, that corpus can grow to 152 CR. So think about it. There are multiple cases, and try to reflect upon it. Try to go through these tables again if the need be, or just reflect upon it that there are four variables and how powerful this equation is. And if you are able to understand that which variable affects the returns, how, and what can we control, and what can we maximize, the end result can be drastically different from whatever end result we have been seeking today. So that is the whole intent of this chapter. Now, a quick reality check. All these figures are ultimately numbers, because these are not, what we get. Even if our portfolio compounds really well, still there will be taxes, there will be capital gain taxes, there will be income taxes, then there will be inflation. So the reality is that the headline numbers, which look huge enough, might not be that huge 30, 50, 60 years later as such. Why? Because inflation is also playing. And there is an invisible enemy, which is like, okay, of course, inflation and loss opportunity cost, and increasing lifestyle costs, and our aspirations are increasing. So that is the invisible enemy. But having said that, should this discourage us for compounding, or should it encourage? Because either we want or we do not want, negative compounding is always at play. Even if we do not do anything, inflation is going to be there. Our cost of living is going to increase. Our students, our children will have higher fees than what we used to have. Our lifestyle costs will rise. Real estate will rise. All these things will keep on rising. So that is a negative compounding at play. If we do not do anything, we are losing capital. So the only choice left is positive compounding, and to be cognizant that we have to do this positive compounding, and how beautifully and how fast and efficiently we can do is the total game as such. So that finishes up part one of the book. Now, part two is compounding through equities. So I started with a simple quote saying that earning does not mean saving. Saving does not mean investing. And investing does not mean investing wisely. To become wealthy, it is important to earn, save, and invest wisely. So, on that note, let us move forward. So, why is equity the greatest wealth engine? So to explain that, I have taken this cash flow quadrant from the book Rich Dad Poor Dad by Robert Kiyosaki. So he has beautifully explained this concept of cash flow quadrant, where all of us can fall into one of these four quadrants. One is being employed, self-employed, business owners, and investors. So this can also be treated as a hierarchy that we have to, um, wherever we are in this cash flow quadrant, our aim should be to move to the subsequent quadrant. So the lowest being employed, then self-employed, then business owner, then investor. All of us are prudent here. We understand the differences. But the point I want to derive is that the best quadrants are business owners and investors, because these quadrants give us something which is called which is time freedom, and these quadrants give us something which is called leverage. So how equity can help us get into these quadrants? Because for building a business, it is not easy. There are a lot of moving parts. We have to have a team, we have to have processes, we have to have systems, we have to have a product first, then we need to have a product market fit. And we understand that there are a lot of moving parts as such, and it is not definitely not everyone's piece of cake. But equity is like a cheat code. It allows us to invest in businesses and become part owners. And suppose if we have to become investors, say tomorrow if we want to become Shark Tank investors, so we want a very big portfolio size for that. We need to have crores of rupees to be able to fund startups, and if even if not appear on Shark Tank, even if you have to open up a venture capitalist firm, for that we need crores and crores of rupees to start with. So the business owner and investor quadrants are not easy. They are very difficult to be in. But equity provides us a cheat code to enter into these quadrants. When we invest in equities, we are able to buy businesses, the portions of businesses, and we don't have to worry about receivables. We don't have to worry about price fluctuations. We don't have to worry about uh, you know, uh, managing the balance sheet, managing employees, raw material cost, efficiency. All those things we just need not do, and we don't need to have crores of rupees, even actually thousands and lakhs of rupees we can start with. So that is why equity is one of the greatest wealth engine, because it allows us an instant participation in these two quadrants. Like next, I'd like to do some myth busting around why land feels safe and why compounding doesn't. So if you we see compounding in our equity is more powerful than real estate investment, but still majority of Indians are still putting their money in real estate and are ignoring this asset class altogether. A lot of us in our family is also doing that. So what is the myth and what is the reason? People think that land is safe and stocks are risky. So, do you think that the prices of land is same? No, it also fluctuates daily. If somebody says that, okay, I want to buy this land for 1 CR, that means he's, making a buy call. And if somebody says no, the 1 CR is too high, I can buy it only for 80 lakhs. He's making a lower call. And accordingly, that notional price of the property will actually keep on fluctuating. But the only thing is that we do not see that volatility. That volatility is also there in property. It is also there in land. We do not see it. In stocks are more transparent, and we see that demand and supply variation daily. That is the reason that we feel property is safe, but and stocks are risky. But it is not true. Second point that people think is that land is at least tangible. I have something to see. But tell me one thing: how tangible is a land which or maybe what is the use of that tangible land if there is a dispute on that land, if you are unable to find a buyer when you actually need the money, there is nobody who is willing to pay the amount upfront, or somebody wants to buy but his loan is not getting approved and he doesn't have that money. So that is a kind of risk with land, even if it is tangible. But if you are unable to sell, what use it is? And stocks are no less tangible. It is just that we see the our ownership in demat accounts, but we are investing in real companies. Those real companies have factories, they have offices, they are doing real work, and they're earning real money, and we are able to cash on that real money. Third myth is that property always goes up in India. So that is also not true. There are always cycles, and it depends at which pocket of the country where are we, and where in the cycle are we. And same is with stocks. Where are we in the cycle? Fourth is that stocks are gambling. It is not at all gambling. This cannot be further from truth. If somebody feels stocks are gambling, maybe our process is incorrect, or we do not have sufficient knowledge about it. And our parents made money only in land. That is another reason that why we think that real estate investments are very powerful, because they did not invest in this asset class as such. At least most of them, and that is the reason we do not have that kind of uh, knowledge as such. So coming to the next chapter, this concludes the fourth chapter. In the next chapter, I've tried to discuss a very simple concept of what do you keep. So here we have taken two examples of two you know say metropolitan say metro cities young adults. One is Raj, one is Rahul. So both are earning well. Raj earns more and Rahul invests more. So who do you think is richer? Raj is earning 2 lakh rupees per month. Rahul is earning say 1.5 lakh rupees per month. Raj is spending everything, or maybe worse, he is taking a loan on credit cards, or a small, he's paying more EMIs, and he's actually spending, say, 2.1 lakh rupees, or even if not that, he's spending, say, 1.8 lakh rupees, or 1.9, or maybe 2 lakh rupees. He's not basically earning more, but he's not saving more. But Rahul, on the other hand, is earning less, but he is able to manage his expenses in 1 lakh rupees and invest a difference of 50,000 rupees regularly. So who do you think has a brighter future? Who do you think is richer? So what the point I want to highlight is it doesn't matter what we earn. What matters is what do you keep. And wealth is built by what we keep. It is not built by what we earn. And even if Raj earns more and spends it all, Rahul earns less. He saves the gap and invests. And that is why the right formula should not be income minus expenses is equal to savings, but it should be income minus savings is equal to expenses. Maybe what Rahul was doing is that he just had an SIP of 50,000. So whenever his salary was credited, he's investing that 50,000. Whatever is left, he's managing his expenses. So this should be the right formula to think about. Income minus savings should be expenses. And the key takeaways here are simple that fuel is the gap. It is the gap between what we earn and what we save, or rather invest. And when we are delaying our, delay is actually giving us freedom. So when we are spending less and investing for a brighter future, it is not that we are living a miser life. Even 1 lakh rupees is sufficient to provide a decent life as such, if you think about it. But what we are trying to do is that we are, scheduling our freedom. That delayed gratification is the key here. So save, then spend, and always invest whatever we save. That is the key takeaway here. So the next chapter, I'll just quickly try to highlight it. How technical and fundamental analysis are actually yin and yang of equity. So most of the times, what happen is that people who are fundamentally inclined discard technical analysis altogether because again because of certain myths that technical analysis doesn't work in long term. It is for traders, and there's also some sort of ego that okay when it has some sort of fundamental analysis require more bandwidth, and that why it gives you that feeling of being very intellectual that okay I've done a lot of fundamental analysis, so that gives a kind of kick as such. So that is the reason a lot of people maybe because of their egos or lack of awareness or some sort of misunderstandings do not want to touch technical analysis at all. But the thing is that with fundamental analysis, there is only so much we can understand. With technical analysis, we can understand whatever it is like the missing piece. And when we combine the both, so we are able to understand that what kind of earnings a company has and what kind of market sentiment that company has. So these are two very important things to understand. It is not just the earnings because of which the stock price is reflecting, but it is also the market sentiment because of which that price is showing. So fundamentally, it is very difficult to understand the sentiment part. It is important. It is and when we combine both these, we are actually able to have a more potent toolbox with us, where we are able to gauge an earnings of a company and also market sentiment, and accordingly we are able to act. Key takeaways are again very simple. That it is not an either or debate. It is not that one should do fundamentals or one should do technicals. Both answer different questions. So treating them as rivals, it just creates blind spots. We just don't want to see a portion uh, of stock market investing assets. And better decisions come when we combine both the lenses. And technicals matter more, not less, when the holding period is longer. That we'll see in the subsequent chapters. And we need and it helps us with timing, better risk control, and exits, all those things. So this completes the initial foundational part. I think we are so let us start with the third part of the book, which is the compounding secret. So this is the longest part of the book, and I think we will not be able to complete all the secrets today itself. If we try to do that, maybe somewhere we wouldn't be doing justice to the topic. So what we'll do is we'll start discussing some of the concepts in part three, and maybe we can stop somewhere in between and continue this in the next book club session as well. So I started with a very simple quote again, which says that not all secrets are hidden. Some are simply ignored. All the members of this meeting are profound investors and have a lot of experience as such. So it is not that I'm telling something which is actually very hidden. Some things you might not be knowing, and it might act like a bulb on moment. But some things might be just like a quick refresher and like a quick summary of whatever we have been doing, and it might act like connecting the dots. So on that note, let us start diving on all the compounding secrets. So the chapter 7, I've tried to combine the secrets which gauge demand supply equilibriums and the market psychology. So the secret one says that all chart patterns ultimately gauge the demand and supply equilibrium. What I mean to say here is that we tend to obsess over chart patterns, and we try to find perfect patterns and go very nitty gritty about it, and we try to learn a lot of patterns as such, and do a very deep dive research in learning patterns are very very important in investing because they ultimately reflect. But what I want to tell you is that whatever the pattern is, the key is that ultimately we are trying to gauge the demand and supply equilibrium. We have to gauge that when this equilibrium is shifting towards higher demand, that supply is getting drained and demand is being generated. Let us take some quick examples. A cup and handle example. So what happens in a cup and handle, that stock price starts correcting and the weak holders exit. There's some sort of supply absorption here, and the stock eventually bottoms out. That means the supply has almost exhausted, not completely, but at least it is sufficient so that demand has started to rise again. And now demand starts to overpower supply, and that is why the stock price again starts going up. And this, if this is the pivot point, then a stock price again corrects for a while, maybe as a time correction, or even falls down some 10-15% and forms a handle. So this is like the final shakeout, the test supply, that whatever supply was left is finally shook off, has been shook off in this handle. And after the breakout, the demand overwhelms supply and the breakout is successful and the stock begins its advancing journey. Similarly, if we see a VCP pattern, again the same thing is happening, nothing different. That sellers are heavy, buyers are taking control, sellers are heavy again, buyers are taking control, but this time with less force. That is why this cup shape is smaller, because less sellers were left. Now again the same is happening, but furthermore less sellers are left. So basically the third time, fourth time, of whatever whichever VCP pattern this is, ultimately what will happen is that the finally the sellers will get exhausted and all the supply will be squeezed and the demand will now overwhelm. And when the demand overwhelms supply, there's a breakout and the stock starts moving up. Same thing again, demand supply equilibrium. Same is with rounding bottom pattern and this pattern, that the price corrects and there is a quite institutional accumulation. When we see a low cheat, that is a heavy volume breakout at the low cheat area. So it is a sign of quite institutional accumulation, again signifying demand. And when there is a structural trend change and there is a structural change in the industry or the sector as such, then this price starts moving in the advancing territory. Again, this is a demand supply equilibrium that we are trying to gauge. This is also same thing where there's a consolidation and sideways the price is not moving anywhere because the bulls and bears are in equilibrium. And when volume expands and a breakout happens, that means now something has changed in the industry or in the company as such, and because of which the breakout is now successful and now demand has overwhelmed supply and hence the stock is moving up. And same is with the tight area, the tightness that we see in the chart. So what this tightness signifies is that institutionals are in control and whoever is selling, institutions are quietly accumulating it and the price is not moving everywhere. So different chart patterns, same fundamental phenomena, that we are trying to gauge where the how this shift is taking place and when from supply to we are coming to demand, and we want to take part when there is a change in this shift as such. And patterns don't predict the future, they just reveal when supply is no longer strong enough to stop demand. So that was the secret one. Secret number two, that we should always be the last weak hand. So if we broadly classify whatever our trading or investing style is, ultimately we have to do two broad classifications. So it would be weak hands and strong hands. Who are strong hands? Who don't want to sell at any cost. They are just there. They are holding it very tight fisted. Once they buy, they buy. They do not sell. They might not add also, or maybe they add, but they never sell. That those are the strong hands. Who are the weak hands? Price fluctuates 5%, 10%, 2%, 3%, and they think, oh my God, I'm going to lose all the money, and they tend to sell off their position. Though they are the weak hands. So the secret number two is that we have to be a weak hand. There is no pride in becoming a strong hand. Why? Because it negatively affects our compounding. So whenever there is a trend change, we have to exit. We have to need to have exit calls, but we should be the last weak hand. We should not be the initial weak hands who are prematurely exiting for no reason. So we should be the last weak hand. If we take the simple tide example, that we have to enter when the tide is rising, and we have to ride till this trend is continuing, and whenever there is a trend shift, we have to exit. So that is a quick takeaway from this, that we have to enter at the right time, ride the wave completely, and whenever there is a trend shift, we have to also exit. There is no pride in acting very strong and ultimately getting collapsed with the wave. It is prudent to exit when there is a trend shift for the sake of compounding. So that was secret number two. Secret number three is that a late entry can be compensated with better allocation. So think about it. When we there is Whenever there's a trend change in a company, usually when there is a structural trend change, usually it starts with a rounding based pattern. And as an investor, we can think about three entries: low cheat, mid cheat, and breakout entries, right? So if we see this chart, so there could be low cheat entry, mid cheat entry, and breakout entry. So at this point, what is happening? The bottom is trying to form, but there is no guarantee that this will, the price movement will not again falter. So this is very high risk zone, and the reward is also higher. When we talk about mid-sheet entry, there's a balanced risk reward because the bottom has for sure formed. The price has appreciated um, quite more, and now there is more stability. That at least we know that this could be a stop loss. That this is a definite bottom because we reach the mid part of the cup as such. So it has a balanced risk reward. There's a lesser amount of reward left, but risk is also less. And then there is a breakout entry where the risk is lowest, and there is a lower initial reward, right? So, what I want you to understand from this is that whenever we enter here, we enter here, or even we enter after the breakout has happened and the price is now pulling back to an EMA, or maybe it is pulling back to the support level. So, we can actually, take our entries even at a later stage, not just at the breakout level, but even after the breakout, when small new bases are formed or when the price is pulling back to an EMA. And if we want to make the most of it, we can simply change our allocation. So, what the simple rule to think about it is that we say if we set a 10% stop loss of a 10,000 rupees position, um, is equivalent to a 5% stop loss on a 20,000 rupees of allocation. And it is also equivalent to a 2% stop loss on a 50,000 amount of position. So the key point I want to drive here is that for the same risk, if our initial risk can be minimized, we can allocate more and we can compensate for the late entries. So if we find certain ideas which are moving really well and we have missed low cheat, mid cheat, or breakout entries, we can compensate it with better allocation and we can still make a lot of money even after wherever we are. But only thing to be cognizant here is that when we are increasing our position size, we have to take the position very close to the support level or very close to the EMA when the pullback is happening, or when the pullback has happened, it is just bouncing back. Maybe just there we have to take so that our risk percentage is less, and that way we can allocate more. So that is secret number three. Secret number four is that market leaders move the market. So we are just coming out of probably coming out of a bear market, and the market seems to be turning around. But what happens time and again is that there are market leaders and there are market laggards. It doesn't matter if the company is strong or not. Even the good companies, some of them will move first and a few of them will follow. So, for the sake of simple understanding, we can classify companies into market leaders and market laggards, right? So, ultimately, the market, who is moving the market, if you start thinking about it, it is the market leaders who are moving the market because laggards have not started to move, but the market is moving. So who is moving that market? The leaders are moving the market. So if we, you know, sit down and we wait for the market to fully recover, if we say that okay, until Nifty 50 does not cross 25,000 mark, I'm not even going to invest a single penny in the market. We might actually be late. because the market leaders have started to move, because of which from 22,000 it is now coming to 25,000. Until the time we start building positions at 25,000, the leaders have already moved, and the market was moving and probably will keep moving because of those leaders, and those idle entries might have been missed. So instead of waiting for the market to recover fully, what we should see is, we should see at the signs of initial recovery, and we should start building our tracking positions at least. So we should be seeing that during the fall, which companies are staying strong, which companies have higher relative strength, and we should start building our positions there. We should see which companies are now starting to turn around and have started to form, new bases, and we can start from low cheat with lower allocation assets. But to not participate in these market leaders altogether might cost us a lot of multi-bagger opportunities. So that is the key message I want to derive from this secret. Coming to the next secret number 5. If somebody wants to, have a question around any of the particular topic, feel free to interrupt me, and we can have a quick discussion around it. And if somebody, have a counter argument, I would love to hear that, and we can have a discussion around that too. So far it is going fine. We'll just quickly cover a couple of more secrets, and then we'll take this to next session, because anyway it would be difficult to do justice to the topic and cover all the 36 secrets and even the part 4 in one meeting as such. So we'll be discussing a couple of more secrets, and then we'll be taking this to the next session as such, right? So whenever somebody has anything to say, please feel free to stop.
Nimish, I had a question. Hi,
Yes,
Pooja
please.
here.
Yes, Pooja. Yes,
So
please.
firstly, really, really proud to see your journey, Nimish. Very proud, and the kind of perspective you bring to your investing. I've interacted with you briefly on your
Yes,
tranching,
yes, Pooja. Ji.
and very, very heartening to see the perspective you're bringing. Bravo, firstly.
Thank you
Secondly,
so much, Pooja.
I'd like to just kind of just play devil's advocate here on the
Yes,
leaders aspect. So
yes, yes,
there are a lot of investors who invest in small cap and micro cap companies
yes.
only.
Hmm,
So they would probably just pick up a sector
hmm,
and then look at, maybe the recent IPO, the typical Mark Minervini kind of setup,
hmm, hmm, hmm,
the template, the IPO template
hmm,
setup. And they would look at sectors which are leading and then
hmm,
look at the consequent
hmm,
new IPOs in that particular sector. So, for
hmm,
example,
hmm, hmm,
the Wari set of companies
hmm.
which did phenomenally well, in
Yes.
that period. I think they gave 1,000% plus,
Hmm.
return
Yes.
over a year's period. So, I just want to
Yes.
kind of get your perspective there. What is
Hmm.
your view there?
So, see, market leaders can we can think about it in two manners. One is the stock itself, and a
Mhm.
second way to think about it is the sector as a whole. So, what
Right.
you are saying is actually it agrees with this statement, and market leaders move the market. So, but the only difference is that we are talking about sectors now instead of individual stock. So,
Mm-hmm.
when we what perspective you are bringing, and it is an excellent perspective to have, that suppose if the market is seems to be turning, and the leading sector becomes, say, auto, power, or any other sector. So we try to again position ourselves in that market leading sector, and now in that sector we are trying to find a very small fish, because we believe that this pond is going to grow at a very rapid rate, and we are
Mm-hmm.
trying to find a very small fish in that pond, so that that small fish also has a room to eventually grow with the pool. But but what will not probably happen is that if we choose a very beaten down sector and we choose a very beaten down company,
Mm-hmm.
then the chances of getting a multi bagger out of that script is very, very, very low. There could still be exceptions, but if we talk about the sentiment, that where the market sentiment is there, so market sentiment
Mm-hmm.
is not favoring the company because it is like ignored already, and even the sector is ignored. So the chances of that becoming a multi-bagger are very feeble. On the contrary, if we either can think about the companies and we can directly start investing in those companies, because even if they do not become 100, say 1,000 percentage or 100 baggers as such,
Mm-hmm.
but at least
Mm-hmm.
those movie companies will move fast. And when they move fast and we take a timely exit, then we can redeploy the capital in fresh companies. So that way, the compounding is taking care of itself, even if we are investing in market leading companies, or if
Mm-hmm.
better, we are able to find market leading sectors and hunt for small fishes. That also is
Okay.
definitely a strategy.
So what I was referring to, Nimish, are small cap companies who've been recently listed. So they're not
Hmm,
beaten down. They
hmm,
are, so let me just, let's say, look at QPA, which is like a small cap.
hmm,
Vis-a-vis and Hitachi Energy, and I believe you've done a 7x in that. Vivek just mentioned it in yesterday's inner circle.
No,
Hitachi
not
was it
seven
or Power
yet, but
India? Yeah.
yeah, not
So
yet, but yes, approximately 4x
yeah. So
was.
what I just want to understand is like, so, if I looked at the chart of Hitachi and I
Hmm,
looked at the chart of Coupa has been
hmm,
recently listed, it's doing
hmm,
fairly well. The delta
hmm,
from here, from
hmm,
here. So let's
hmm,
say Hitachi is a leader in the past space.
hmm,
Coupa has just come in. If you look at both the charts, Hitachi is given a fair amount of return. At
hmm,
this point of time, Nimish, I want to
hmm,
get your view as
hmm.
to how you would view, because Coupa is not a beaten down stock. It's a new player.
Yes. Hmm, hmm,
And Hitachi's it's given a fair amount of return.
hmm,
I'm not saying that there's no potential for greater. It can go
hmm.
100x also.
Yes, yes.
How do you view both these stocks, and how would you kind of then allocate positions or take positions
Yes.
in these stocks as of today?
Yes, correct. So I am going to take another session in the evening on tranching. So there, this we can have a deeper discussion there as such.
Okay.
That,
Okay.
but to bring it short, ultimately, see
Mhm.
what matters for us as an investor is that we want to grow our money. So for
Right.
growing our money, what we want is that we want to seal the leakages and we want to, increase the amount of whatever we are being able to save. And say if
Right.
we consider a bucket to be
Right.
a portfolio, we want
Mhm.
to put in more amount in the bucket and we want to seal the leakages. Leakages we cannot ignore or eliminate altogether, but we
Right.
want to bring down those leakages to a very small number. So one way to look at it is you can invest in both. That is one. Second,
Mhm.
that in Hitachi Energy you can invest in core portfolio, and Cupa you can invest in satellite portfolio.
Satellite. Correct.
Second perspective is that since Hitachi, when it was at 7,000 rupees, that was also an expensive price to pay, and
Mhm.
its P was probably 140 or 150. And even if we see today, the PE is above 100 only, and it has stayed above 100 for quite some time, for 3 to 4 years as such.
Right.
So nobody can tell if it will sustain that PE or it will not sustain that PE. Why? Because till the time growth is there, the price will keep might keep appreciating, and the
Mhm.
price whenever it depreciates, it is because the growth has tapered. So
Mhm.
what we have to see, I understand your point of getting that delta from here on what is there, but
Mhm.
if Hitachi Energy can say keep growing for next 4 years, say if
Mhm.
Hitachi Energy can keep growing for 4 years, whereas if Cupa is being able to grow only for 2 years, so Hitachi
Mhm.
might be a better bet. But if it is vice versa, then Cupa might be a better bet. So that is why we do tranching, and that is why we have core portfolio and satellite portfolio that nobody can say. We can just stack probabilities. So that is also one of the secrets, that we can just stack probabilities.
Right. No, but I think you've explained it fairly well. Thanks, Nimish. Yeah. Thanks.
Thank
Yeah.
you. Thank you. So let's move to the next secret, which is secret number five. A quick fall without a change in fundamentals is somebody else's opportunity to buy. So we have recently seen it that fundamentals did not change because of the war announced, just because of the war announcement. A lot of volatility was there in the market, and a lot of prices fell just like that. So whenever that happens, it is not that a new downtrend has started. So we should not, confuse lows with bottoms and highs with tops. Is what I'm trying to convey here. That whenever there is a fundamental has not changed and everything is fine, and we know there is a macro event which is affecting the market as a whole, and there is a quick fall in price. So that is actually somebody else's opportunity to buy. So when the fall happens, it happens sometimes so quick that we cannot act, and that is okay. But what we can see is the follow-up move. So Mark Minervini explains this beautifully in his book that whenever there is a fall, it is okay that the fall has happened because it has already happened. What we have to see is that how is the bounce. So some scripts will bounce like a tennis ball, while others will behave like an egg. So if there is a strong demand, the script will bounce back like a tennis ball, and if there is demand is missing, it will behave like an egg. That it is the price has fallen and it is now just staying there. So even though the tennis ball has bounced back, it might make sense to still invest in tennis ball because there is demand. And even if uh, the egg companies are now looking cheap, but if the demand is missing, it might not make sense to invest in those companies. So the key takeaway here is that whenever the price falls, it is okay that the price has fallen. We just need to see that what is the follow-up move, and accordingly we have to tighten our stop losses, and accordingly we have to act. So the next chapter clubs secrets which are more regarding the power of technicals in long-term investing. So we have already discussed that how long-term investors shy off from using technicals in their investment frameworks as such. But why? But what is the power of technicals in long-term investment is what we'll try to explore in this chapter, and we'd also try to understand that why it is actually more powerful, not just not equally powerful. More, it might be actually more powerful. So secret number six is that technical analysis is more powerful for long-term investment. So it sounds counterintuitive that when we are investing for long term, what is the need of seeing charts? We know the business, we have invested in it, and we know we have to invest for long term, and we are just there. So that is the thing. So let us try to understand that with a few examples and case studies that why how it is more powerful for long term investment. Okay, so those charts I'll show in the subsequent slides. But as of now, just try to understand this point that when we have technical analysis as one of our tool in our kit, so it becomes even more powerful for long term investments, particularly because we are able to one avoid long term consolidations. Two, we are able to avoid deep drawdowns. So we have already seen that what kind of impact time has on compounding. So imagine that if somebody is a long-term investment, he has invested in a company for 15 years and the company has compounded really well. But if after 15 years that company enters into consolidation and somebody's investment horizon was for say 18 years and that company has entered into consolidation for say 5 more years, and eventually he ends up selling that company at the 18th year. So these 3 years of lost opportunity cost are very high because that company had already did its job, and there was no mechanism to reallocate that capital to a future winner as such. So that is the key issue with not using technical analysis. That one, somebody might be invested in consolidation phases. Second, there might be deep drawdowns that when the company was growing, somebody has made multiple excess in that company. But when the degrowth started, and if we are till the time the quarterly results appear, some 30-40% drawdown has already happened, and we have lost a lot of powerful compounding assets. So that is what I want to convey with this. Next secret is that longer the horizon, the noise will be less. Let us take a few case studies here. So I've just considered an example of Eicher Motors here, a good company, a good compounding company, all of us know. But see how the price movement varies with different time frames. So the same company. This is the chart on daily time frame. If you were to follow any of the buying selling strategies, the entries and exits would have been really frequent because there is a lot of volatility. See, there is a gap down here and a gap down here and a gap down here, maybe a gap up here and a quick fall here. There's somebody buying into it. Very noisy chart, actually. Even though it is compounding in nature, but very noisy. But when we switch the time frame and come to weekly, much smoother here. So this is a big drawdown as such. But otherwise, if we consider that, okay, this is again a consolidation and then there was a breakout and then consolidation, then a breakout, much cleaner on a weekly time frame. But if we understand that there's a mega trend and there's a proven execution, the commentary is good, the future prospects are good. So this is the idea of core portfolio and tracking companies on monthly time frame that once the breakout happens, say at this level, there is actually no exit as such. Somebody can very peacefully ride it without worrying about any of the noises. So the key takeaway here is that not all companies will be able to track on monthly. Of course, we'll be able to track only the core portfolio companies in the monthly time frame. But higher the time frame or longer the horizon, lesser will be the noise, is what I want to convey with these charts. Secret number 8, like we have already discussed, that no one can predict. No, absolutely no one can predict. If somebody is saying that, I can make a promise to you that you will be making X amount of returns, X percentage of returns in a stipulated amount of time. So please stay away from that person, because even the promoter would not know, even the government would not know. Even if we know the PM of a country, say if we even if we are family with Narendra Modi, we do not know how Trump will act, right? So to say that there are so many factors associated that absolutely nobody can predict, even if we know that our company is going to make great returns. And even if we have that insider information, still we do not know how the market is going to behave, or the overall sentiment of the market is going to be. So absolutely nobody can predict what will happen, but everyone can stack probabilities, and this eventually is a game of probability. So the more we are able to stack the probabilities, the better will be our odds of getting successful in this game as such. So secret number 8 is that don't predict, but start stacking probabilities. Start learning that how can you stack those probabilities, and start stacking those probabilities. And yeah, that is the key. Uh, Next secret is that secret number 9, that each branch compounds. So branching is very counterintuitive, because we think that um, if we invest say 1% of our portfolio and it becomes 2x, it will still be 1%. But if we invest 5% of our portfolio in one go and it becomes 2x, it will be 5% rise in the portfolio amount. So it becomes very counterintuitive. Why are we investing less amount, and why are we tranching altogether? Why don't we want to go all in? So the point I want to highlight here is that each tranche compounds, and what happens is when the stock is moving up and we are adding to our position, and suppose the stock moves from here to here. So this tranche is compounded 70%, this is compounded 60%, this is compounded 50, 40, 30, 20, 10, right? So the later tranches have not contributed really well, but what they have done is that the past tranches are actually absorbing the risk associated with the newer tranches. So when we are tranching here and the price is here, this tranche is in profit, this is at break even. Now we are adding. So these two tranches are in profit, and this is at break even. Now when we are adding again, these three are in profit, this is at break even, and so on. So what happens is, how we have to look at our demats will not show this, because what will happen is, if we have taken say X amount of tranches, our average buy price will be here. So when we see our demat accounts, it will be like my buy price was 100 rupees, and the price is at 200. Oh, I made a 2x here. And when we tranche, it will show that your average buy price is 150 rupees, and you will only see 50% of return. But the actual amount that we have made, that will be very high, because each tranche is compounded. So that is what I want to convey here. That when we see, even if the demat shows just the average buy price, at least we should note that where have we done the tranching in the charts or in the journal, and we should be seeing that wherever the price is, which tranche is actually contributing how much, and what is the cumulative, what is the risk, and what is the return that I will see. Next is secret number 10, which says lower time frame means lower gains, and higher time frame will mean higher gains. I have taken a very simple case study of Mazgaon Dock, which was a multi-bagger stock. So same strategy, if somebody would have followed, say following an EMA for exit, say 2020 EMA, and somebody has taken a breakout here at entry level, and this is the system that we are following 20 EMA, and whenever there's a breach in 20 EMA, we are simply taking an exit call. So since there was a lot of demand, as is visible, a very good quality base, see very low volumes here, very high volumes initially, very low volumes in correction, and then again demand coming back and stock breaking out at very high volume. Very good chart, actually, right? Somebody enters here, follows a daily time frame, exits here, makes a very good 85% gain on a daily time frame. Very good returns, right? But if somebody took the same entry here and simply use a weekly time frame instead of daily, what would have happened? Now, naturally, this 20 daily EMA will become 20 weekly EMA. And instead of exiting here, now that person is getting exit somewhere here, because here the weekly EMA was not breached. It was again bought in, and the candle has closed above the EMA as such. And somebody could have followed your weekly chart for this particular script. So he would have made 123% gain, which is significantly higher than 85% gain. right, on a weekly time frame. Although this is not a core stock, but just for illustration purposes, if somebody knew that what kind of potential it holds, and you have a lot of margin of safety, and at least not initially, one should not tranche this on monthly, but even if suppose say somebody tranched on weekly and knows that the triggers are still there in place and there's a strong order book growth. And eventually, if we shift our satellite companies with a good margin of safety to monthly time frames, then what can happen? So if somebody would have switched this like that to a monthly time frame after making good amount of portfolio and just stayed there. So now this will become 20 monthly MM. And see, no exit here. Fall was there, but no exit. Again, got up. Fall was there, no exit. Again, it started going up. Consolidation, again, it started going up. Again, fall was there. And as on 15 December, when I took the screenshot on 2025, it was taking support at 20 monthly EMA and it was again getting bouncing back. So it was almost like 400% gain and still counting then. I do not know how the stock has done now, but just by changing the time frame itself, this is the potential that we can think 85% to 400% gain. Of course, time required is also more. But if once we find a winner, so this also highlights the importance of riding a winner and importance of higher time frames as it is. Yeah, so I'd like to uh, take a pause here and thank all of you for such patient listening because there are a lot of secrets to cover, total 36 of them. And we might not be able to do justice. We have been into the session almost for 1.5 hours, and it might take another 1.5 to 2 hours for completing the remaining part. So, on that note, I think I would like to stop the presentation here, and we can continue the discussion whenever everybody's comfortable, maybe next week or maybe a week after that. So that way we can talk about it. Yes, if there are any questions so far or any feedback, I would love to hear that, please, and we can have a discussion on that.
Yeah. So Nimish, I would like to say something.
Yes, Sanjeev, please.
Okay. So first and foremost, heartiest congratulations to you for publishing this book. It
Thank you
is
so much.
inspirational
Ji.
for me because you just mentioned that you started your investing journey in COVID, that is 2020, 2021.
Yes,
And
sir.
from that particular period till 2026, within a 5-year period, if you are able to publish a book and if you are able to author, you have become an authority, so to say. So it's a great journey. Thank you very much for that.
Thank you so much.
And congratulations for that. And as we had discussion, I ordered the book hardcover from Amazon. So I have acted immediately on this.
Thank you so much, sir. Thank you so much. It means a lot.
And I am also looking forward for the second session of the second part of this particular book.
Yes, sir, definitely.
Right. That's all.
Thank you so much, sir. Thank you so much, sir. So I would just like to highlight one of the secrets that late entry can be compensated with allocation. So maybe I never thought that I would develop so much interest in this field as such, but maybe it is, because ultimately when we are investing in equities, it is like we are investing in businesses. And since I have that entrepreneurship acumen and interest, so that is one fundamental reason why I started to resonate with it as one thing. And a second thing, I also was having a discussion with my friend. And I was feeling guilty while talking to him that, yeah, why did we come across these concepts so late in life? Because we could have already been financially free. But while having that discussion, one point that we realized is that, say, if we started investing at the age of 18 or 20, so that time our earning capacity was also low. So maybe we could have invested some few thousand rupees, if not lakhs of rupees. So even if somebody starts late, the key message is, and if somebody understands the concept, we can just bump up our initial capital. Because as a student, I might have started up with a portfolio of 50,000 rupees, but as a business owner, I can start with a portfolio of at least 10 lakh rupees, 20 lakh rupees, and some of our community members have started with even higher amount of. So that is things, and just beautiful exponential learning with all of you together in the community, and the kind of learning that Vivek ji shares. So all of that is probably compounded, which I'm able